Anthony Grasso here, bringing you financial news that you can use. In this video, I'm going to do a stock analysis on NetApp. Now, is this cloud technology company worth investing in right now after it had a stellar quarterly report that just came out? Well, let's find out together. I'm going to go over a summary of the company, its product offerings, recent headline news, financials, analyst projections, and then I'm going to give it my buy, hold, or sell recommendation for both your short-term and long-term growth investors out there. And as always, folks, don't forget to smash that like button down below. Definitely helps. And consider subscribing. Hit that notification bell if you like to hear daily stock reviews and recommendations from an unbiased source. So let's get right into it. This video is brought to you by Webull, which is an online brokerage trading platform where you can buy stocks, options, ETFs, and cryptocurrencies. If you sign up today and deposit any amount, you get up to 12 free stocks by using my referral link in the description down below. All right, so NetApp, it's a cloud-led data-centric software company. Now, the company delivers a portfolio of cloud services and storage infrastructure powered by intelligent data management software. The company operates through two segments, the hybrid cloud and the public cloud. Now, the hybrid cloud segment offers a portfolio of storage management infrastructure solutions that help customers recast their data centers with the power of cloud. Now, the solution is designed to operate with public clouds to unlock the potential of hybrid multi-cloud operations. Now, its public cloud segment offers a portfolio of products delivered primarily as a service instead, including related support. Now, the portfolio includes cloud storage and data services and cloud operation services. It offers a portfolio of cloud-connected all-flash, hybrid flash, and object storage systems. Now, its solutions and services are generally available on the public clouds, including Microsoft Azure, Google Cloud Platform, and Amazon AWS. Now, let's go ahead and look at some of the news of the company that made the stock price go a little higher today over the last couple days. All right, so it reported its first quarter 2023 earnings. It was an all-time quarter one company highs for billings, revenue, gross profit dollars, and operating income and earnings per share, said the chief executive officer. Now, the revenue exceeded analyst estimates by about 2.9%. Earnings per share also surpassed analyst estimates by 20%. Over the next year, revenue is forecasted to grow about 5.5% per year compared to a 4.9% growth forecast for the tech industry in the United States. Over the last 3 years, on average, earnings per share have increased by 3% per year, but the company's share price has increased by 18% per year, which means it is tracking significantly ahead of the earnings growth. And that's going to be a point of contention later on in the video. And they also announced a cash dividend payable on October 26, 2022. That's going to be 50 cents a share. It's to be paid on October 26 to shareholders of record at the close of business on October 7th. So if you want to get on that, you have to get into the shares by October 7th. Now, let's go ahead and look at some of the fundamentals of the company and do a little deep dive. All right, well, today it had a stellar day. It's up 7.8%. It's trading at $78.56 a share and has a market capitalization of roughly $17.3 billion. Now, the company is projected to have $6.7 billion of revenue for the fiscal year of 2023 with a positive earnings of $932 million. Now, the revenues are projected to increase over the next few years to around $7.6 billion by the end of 2025 with positive earnings of roughly $1.12 billion. Now, if you look at the revenue versus the market, the revenue increases of 6.4% per year is forecasted to grow slower than the U.S. market in general. Now, let's look at some key measures of the company right now and do some analytic work. All right, so looking at this company, make sure I have the right one. All right, so first we're going to look at the valuation analysis. Because the company is in the global tech industry and has positive earnings, the PEG and the PE ratios, the price to earning growth, and the price to earnings ratios are the most appropriate valuation measures. The price to book ratio is excluded since it likely underestimates the company's book value by overlooking some hidden assets such as intellectual property. The price to sales ratio is not as meaningful as the PE or the PEG ratio due to the company's positive earnings. Therefore, the company seems highly valued with a PEG value of around 1.79 times, one of the highest in the industry. However, the price to earnings ratio is 18.2 times and above the industry median of 15 times. So it's trading above industry median. Now, the price, if you look at the price to earnings ratio versus the fair ratio, this is the expected price to earnings ratio, taking into account the company's forecasted earnings growth, profit margins, and other factors. It seems like a good value based on that, because the fair price to earnings ratio I put at 20.8 times. Now, if you look at the share price versus the fair value, when it looks at the future cash flows, for this estimate, we're going to use the discounted cash flow model, and it's well below fair value. Our estimate of fair value puts it at $152 a share. Just something to take in consideration. Now, looking at the dividend analysis, the annual dividend is $2 a share at its current price, yields about 2.65%, a level that's in line with the industry average, but above that of the S&P 500, which yields only 1.93%. Additionally, this company is in the minority, as few others in the industry doesn't even pay a dividend. So, and if you look at the cash flow coverage for the dividend, it's a reasonably low cash payout ratio of 43.5%. The dividend payments are well covered by cash flows. Now, if we look at the growth of the company, now the earnings growth at NetApp outpaced revenue growth over the trailing 12 months. This is a trend that is not sustainable if profits are to continue to grow at this rate. However, the result was better than that of the average company in the technology in the industry. Now, earnings have grown 15.2% per year on average over the past 5 years, and earnings are forecast to grow about 8.73% per year. You know, so their earnings are forecast to grow, but not significantly with the industry. So it's not high growth earnings, but it is high quality earnings. Now, if you look at the financial strength of this company, although it reduced the percentage of debt used in its capital infrastructure this year, it has a total debt to capital ratio of 75% and is among the highest leveraged companies in the technology sector. Now, with the interest coverage ratio of 19 times and a quick ratio of 1.45 times, the company should be able to comfortably repay its debt. It does have more cash than its total debt, and the debt to equity ratio has increased from 86.8% to 401% over the past 5 years. Now, the debt is well covered by the operating cash flow of 47.4%. And the interest coverage, the interest payments on its debt are well covered by the earnings before interest and taxes of 18.3 times coverage. And its short-term liabilities of 4.9 billion do exceed the short-term assets, of 4.9 billion exceed its short-term liabilities of 3.6 billion, but they do not cover the long-term liabilities of 5.3 billion. And it's also important to note that insiders have bought more shares than they have sold in the past 3 months. There's been some selling, some buying, but in the past 3 months, there's been more buying than selling. So now let's see what the analysts specifically say regarding this company. Well, the current analyst consensus is a buy. 42% say hold, 46% say buy, and 7.69% say strong buy. So I'm thinking it's more of buy or hold. That's kind of the consensus. And the price target that these analysts have on this company is a 12-month price target of $86.67 a share. On the high end is $120 a share, and the low end is $60 a share. And finally, going over a few of the analyst reports that I could find, the Street Quant Ratings has a buy recommendation for this company. They say it's driven by a number of strengths, which they believe would have a greater impact than any of the weaknesses, and should give investors a better performance opportunity than most of the stocks they cover. The company's strengths can be seen in multiple areas, such as the revenue growth, reasonable valuation levels, notable return on equity, and expanding profit margins. They feel the strengths outweigh the fact that the company has had subpar growth in net income. Well, that's kind of an important thing, and they're reasonable valuation levels, yes, but they're slightly above the industry average. And the Ford Equity Research Report has a hold recommendation. They project that NetApp will perform in line with the market over the next 6 to 12 months. This projection is based on their analysis of the 3 basic factors that influence the common stock performance they look at. They look at earning strength, relative valuation, and recent price movements. And finally, let's go over and see what the CFRA report says. Well, they have a hold recommendation because they see lackluster growth prospects, and I kind of see that too. But they also note there's attractive valuation and robust balance sheet. We are excited about the company's opportunities within the public cloud services, which is seeing traction from key customers like Microsoft. But note more heightened spending levels ahead to support growth initiatives. We like recurring maintenance, software, and public cloud revenue, which provides better visibility and supports long-term gross margin expansion, as well as prospects for the company to upgrade its existing installed base of customers towards all flash. Despite supply constraints, the company appears well positioned to meet the end demand, but their bottom line earnings are going to stagnate and just slightly increase year over year. Revenues might go up more, but they have to invest a lot of money to get those earnings slightly to increase, to get those revenues. And let me bring it back over here. So my buy, hold, or sell recommendation on NetApp? Well, here are my thoughts. Now, yes, the recent quarter results showed positive momentum led by better cloud ARR and a more robust operating margin, hands down. I see NetApp gaining market share, and importantly, as cloud is 8 to 10% of the company's sales and growing, its mix is about 1% each quarter, and this is a margin accretive, and I see it lasting for several years. So I see them growing at that 1% each year, or each quarter, basically. So I expect NetApp to continue to benefit from the growth of cloud storage and a multi-cloud optionality that many customers desire. Now, NetApp continues to see healthy customer engagement and demand trends driven by priority investments in digital and cloud transformations. Now, they do have optimistic future growth, which appears to have been already factored into the current stock price, though. That's my worry, with shares trading around the industry price multiple. Now, the company is tracking significantly ahead of earnings growth. So based on all that information, I am a hold recommendation on NetApp. Now, I do place a 12-month price target of around $85 a share. Now, I personally wouldn't buy into this company right now. I would wait for the news to subside regarding the quarterly report that just came out and buy on the next dip. I would target a price anywhere from $65 to $75 a share right now and hold for the long run. But it's going to be limited growth potential over the next couple years. This is a highly volatile stock anyways. The price movements will be exaggerated relative to the rest of the market. If the market is bearish, and that's what I'm projecting, the company shares will likely fall by more than the rest of the market, providing a prime buying opportunity. Now, I don't think we're out of the woods just yet, and I think we're just going into a recession. And tomorrow, the Fed's meeting to look at the rates to possibly raise it by up to 75 basis points. I think it's going to be 50 basis points because the midterms are coming up, right? But we don't know that yet. So for the most conservative investors out there, this might be a hold and wait to look at the general market and to get cues from it to find out exactly when the right buy price is. I don't think it's today. I think that was the other day before this news came out. Now, I do have to say they do have an excellent balance sheet, and they do have a proven track record, so that's a plus for them. Now, there's risk to this opinion and my target price. There could be weaker than expected global economic growth in general. There could be lower IT spending for companies. There could be narrower margins for the company and greater competitive pressures. There's a lot of companies in this space, as well as increasing foreign exchange headwinds. But what are your thoughts? Please leave your comment down below. What price do you put them at in the next 6 to 12 months? So there you have it, folks. And as always, don't forget to smash that like button down below. It definitely helps. And consider subscribing. Hit that notification bell for your daily stock reviews and recommendations from an unbiased source. Until the next stock update video later today, folks. Ciao.